Hello and welcome to the IPO show, a brand new offering from ET Now with me, Ayesha Faridi, where we discuss the buzzing aspects of the primary market with the IPOs around the corner, whether or not you, as an investor, should be subscribing to these particular IPOs or not. The IPO that we're talking about today is Aether Industries. Now, this belongs to one of the fastest growing specialty chemical companies in India. It's growing at a CAGR of nearly 60% between fiscal 2018 to 2021, according to FNS reports, December 2021. So let's put our minds together and get you the aspects on whether or not to subscribe to this IPO or not. We'll of course have the management as well join in shortly, and we'll get you an industry expert view as well. But before anything else, let me take it across to our research team to find a little bit more about this company and what you as an investor need to look out for from the IPO.
Well, Aether Industries IPO is all set to open on May 24th. Now, this IPO will open for 3 days on May 24th and will close on May 26th. Now, the price band set for this IPO by the company is 610 to 642, and the company is looking to raise close to 808 crore rupees. And if you include the pre-IPO placement amount, then the total issue size comes to around 938 crore rupees. Now, of this 938, close to 627 crore rupees plus the 130 crore rupees of the pre-placement will be from fresh issue, while 181 crore rupees will be an OFS where the promoter will be selling their stake. Now, how the company will use the proceeds of this IPO? Firstly, they'll use close to 163 crore rupees to fund their capital expenditure plans. Nearly 165 crore rupees will be used to fund their working capital requirement, and nearly 138 crore rupees will be used by the company to repay their debt. Now, the company is a specialty chemical product manufacturer, and its revenue is dependent on 8 key products, and of these 8 key products, nearly 7 of them, Aether is the only manufacturer in India. So this is one of the positives for the company. Along with this, the chemical specialty chemical product already has high entry barriers, which is also a positive, and the growth rate of the specialty chemical segment is expected to be at higher rate compared to the normal chemical segment at around 11.2% till FY25. However, on the negative side, if you see, product and client concentration is one of the key risks for the company, because the company generates most of its revenue from the top 10 clients, so that is one of the negatives, and also its revenue is dependent on only 8 key products. Also, changes in raw material prices, because it sources raw material through various vendors and also through export market, that is one of the key risks, and higher freight costs that we have been seeing recently is also one of the key risks when it comes to Aether Industries.
Without further ado, let me welcome on board the two gentlemen at the helm of this company who's going to IPO soon. We have with us Mr. Aman Desai, the promoter, as well as the whole-time director, and also Mr. Faiz Nagariya, the chief financial officer of the company, joining in on the show right now. Gentlemen, great to have you both on the IPO show on ET Now. Welcome on board. Dr. Desai, if I could just begin the discussion with you. I was just going through the RHP, and you are the sole manufacturer of 7 different types of chemicals in the country. If you could just give us an idea about how much revenue these products actually contribute to your books.
Aisha, thank you for having us, and it's a pleasure to be here. In terms of this sole manufacturer, us being the sole manufacturer of 7 different products in India, this contribute about 80% of our overall revenue, and the remainder 20% is covered by other products.
So for the financial year 21, we had around 320 crores of revenue from these 7 products, and remaining was from the other products. And for the September 21, the 6 months, we covered 73% from the 7 products, and remaining was from the other products, which was approximately 180 crores, and remaining was from the other products.
Sure. Okay, so that's of course the revenue contribution. But Dr. Desai, if I could just probe a little bit further about what kind of growth do you envisage from these products? Where is it that they can actually scale up to in, say, the next 1 to 2 years from here?
So in a lot of these products, we already have captured 51% of the global market demand and market share. But in a couple of other products, there's significant headroom for growth. And so, for example, just on a general basis, I think in about 3 to 4 of these 7 products, we have captured only about 14 to 20% of the global market demand. And in one of them, we are in negligible capture of the market demand. And so we envisage growth of 15 to 20% on 4 of these products where we have not captured the global market share yet.
Interesting. Faiz, if I could just probe you further as to what kind of contributions are coming in from other products. And also, I think one important question as you now set to IPO and that the markets would want to know is whether or not the margins vary from product to product. And are the margins higher for products that you manufacture in India?
Sure. So first, I would like to inform you that the products which we have 22 products which are provided in the DRHP, and the 7 products are the ones which we are only the ones in India. We would like to have a mix wherein we know we have revenues coming from all the products. We do not want to be dependent on only any one product or few products. So that is one of the main aims of the company. And going forward now, if you for the margins, see we have 3 business models. One is a large scale manufacturing, one is the CRAMS, and one is contract stock. Exclusive manufacturing. So the margins are divided based on this large scale ownership. So large scale is around 28 to 29% margins for our products. Contract manufacturing is around 29 to 30%, and for the CRAMS we have 70% plus margins. So we are trying to make a mix of these products and achieve our targeted revenues and EBITDAs.
Also, Faiz, what is the kind of bottom line boost that can come in from interest cost savings?
In the first year, we envisage a bottom line boost of around 1.3 to 1.55% increase.
Also, Dr. Desai, because one is seeing inflation skyrocket, one is also seeing supply chain issues. There are obviously higher container costs as well. There are various, issues, almost like a domino effect that inflation is springing upon us. What is the kind of impact that you have seen on your own raw material costs?
Yeah, that's a great question. The impact on the supply chain because of the global parameters and as you said, the domino effect has been severe and has affected each and every company. We have also been impacted, but we have a policy of keeping between 4 to 6 months of raw material inventory, for example. And so as a result of a couple of these policies that we have in place, the impact for us has not been severe as much as compared to the average spec chem company in India and globally. But if I have to throw out a number, I think our profit margins have been impacted between 1.5 to 2% because of these global parameters and the global scenario that we're currently facing.
But Faiz, tell me, were you able to pass on the RM increase onto your clients, and how is the pricing scenario currently working?
Yes, we were able to pass on the price increase of raw materials to our clients, and they were ready to accept it. Because they also know that this increase is because of the international problem it is going on between the crude and the dollars, everything. So we didn't find any problem. So we were easily able to pass on the prices, and the customers are accepted that very well.
Right. Dr. Desai, what is the kind of order book from your CRAMS portfolio? And also, if you could just give us some color on how it's grown over the past 3 years.
Yeah, Ayesha, the CRAMS business model is a very differentiated business model that we have, where we engage with the top technical echelons of various innovator companies across the industry spectrum on a global platform. In terms of the order book, in a 8 to 10 month rolling forecast, as of today, as of September 21, we had an order book of about 40 to 45 crores. This business model has grown significantly over the last 3 years. In FY 2019, we were at 20 crores in this business model. In FY 20, we were at 28 crores or so. In FY 21, we were at 36 crores almost in this business model. And in the 6 months of FY 22, ending September 21, we had touched 24 crores almost in this business model, which is only a half year period.
Faiz, if I could lastly get in a comment from you. As I see it, that over FY19 to FY21, you have managed to double your top line. What I think I want to know, and I'm sure your IPO investors also would like to know, was A, what were the factors that led to this doubling up? And what happens from here onwards? How is it that you see your top line growing forward? Will you be able to double it up with as much pace?
Yeah, so it's a very good question, and I would say that the increase in the numbers, doubling, is mainly because of the products we've increased. We have added new products from 19 to 21. we were 17 products. We added three products in the 2 years, which has given us a boost because these products had higher revenues because of the pricing. And also the new customers have been added. We have added lots of new customers in the 3 years. The customer base has gone up to 130 plus, if you see in the DRF we mentioned. So this is one of the factors. And also one important factor is that the average selling price for our products is increased by 6.8% or 7% in these 3 years, which is also one of the biggest reasons for the increase in the revenues. And going to your another question, like how do we see the trend? We would definitely like to go ahead with the current trend of increasing our revenues year on year and have a good top line to make our investors happy and make them feel that they have invested in the correct company and they are very safe in safe hands.
We have 2 more greenfield production sites coming up, so we are aggressively expanding the production footprint. We have more than doubled our R&D infrastructure, and we have more than tripled our pilot plant infrastructure. And so there's rapid expansion happening on all platforms of R&D, pilot plant and production. And so we do envisage significant growth coming on year and maintaining this trend that we have set in the last 5 years over the next many years, hopefully, so that the investor community can be happy that they've engaged in a company like us.
Dr. Desai, Faiz, great to have you both on the show. Thank you so much for taking time out and speaking with us about Aether Industries, and good luck with the IPO.
Thank you, Ayesha. Thank you for having us, and thank you for your wishes.
Thank you so much.
Okay, with that, we're going to take a very quick break. But when we come back, we'll get an analyst perspective on whether or not you should be subscribing to Aether Industries IPO or not. Welcome back to the IPO show. You just heard from the management of Aether Industries. Let's now take it up forward and get you the analyst perspective. Joining me on the show right now is Vineet Bulanchkar, who is the head of research at Ventura Securities, joining in on the show right now. Vineet, hi. Great to have you on the IPO show. Vineet, I was just chatting with the management of Aether Industries, Dr. Desai as well as Faiz, and they were both telling me as to how the company caters to various products. And out of that list, a sizable revenue component is also manufactured in India. Vineet, what I want to ask from you is, how do you think the demand is for their products within India and of course in the export market as well? And what kind of growth can we envisage and pencil in, say, for the next 1 year?
So, if you were to analyze the business of Aether, what you need to do is you actually need to step back a bit and see how they've grown their business. So for about 4-5 years, they spent only doing R&D, focusing on R&D, and they were focused on the areas where they had got key competencies. So they did not focus on the markets or products. Basically, they focused on key competencies that they have. Okay. And then they further went out and saw to it where these key competencies could be applied. And then they carefully selected products which do not have a sourcing base in India. Okay. They could establish their credentials as an import substitute. And, not many people were also capable of manufacturing their product because their complexities were high. And that is how they have carved out a niche for themselves in the market. Okay. And because of this, what has happened is that they have set up good research outsource services for the foreign innovative molecular companies. They further extend this to doing batch plant production for these companies at contract manufacturing until the product is approved. And finally, then they get into generalized manufacturing for a large number of products which are in ethos with their product portfolio and their strategy as such. So what we think is that, they've grown at a very strong clip from FY19, from 173 crores, they went up to 326 crores in FY21. And, if we see this half year, they have done 234 crores. So, they've done about 76% growth YOY. And, if you project this growth into the future, I think they can easily achieve about 450 crores by this year. And based on whatever the management is planning, we believe that they can easily scale up to about 700 crores by FY24. I do believe that, considering whatever valuations that we have done, we believe that the stock is available at very, very attractive valuations and hence can be bought for uh, investment for reasonable growth, not only on listing, but also for the long term.
Interesting. Also, besides that, Vinith, and I'm going to talk about the valuations in greater detail right now in just a bit, but just wanted your overall view on the chemicals industry, because chemicals is one pocket which came to the fore much before COVID itself. And then we've seen the kind of dizzying heights most of chemical stocks have actually, run up to up until the recent past. Wanted to understand from here onwards, what's the prospect of the chemical industry now going forward?
So, again, we need to step back a bit and look at the Russia-Ukraine crisis. So, one of the largest players in the markets is Germany, and Germany is going to go through a hell of an experience, controlling costs. And keeping that in mind, I think the chemical sector is looking very, very attractively poised, especially those which are niche chemicals and where you have a kind of a monopoly or a large market share in that segment. So companies which have got niche, have got assured contracts and have high growth will be the ones who will be doing well. Commodity chemicals by themselves per se will tend to underperform the market, but niche chemicals, with assured buybacks and captive consumption will mean that they will continue to do well.
Wanted to understand how Aether stacks up with the other listed chemical players out there, and what should then be the fair value?
So, we've done some back of the envelope calculations, and we believe that, the company over the next couple of years, that is in FY24, can, grow their PAT from the 71 crores that they clocked in the first year, FY21, to about 260 odd crores by FY24. And, if you just consider the, taking a fair multiple of 20 to 23 times, this gives you a market capitalization of 6,000 crores, okay, on the pre-issue equity. So, working with a 6,000 crore plus market cap is what we would, request investors to look at, in terms of a, number on the share price, and in the absence of the share price, I think the market cap works out very well. So we think that there is a sizable appreciation expected from here, from the current levels, and valuations are rich, but not, in the extremely overbought levels. And considering the fact that, the management is extremely strong, they've got a very niche portfolio, high growth, and, continued visibility with significant levels of difficulty for competitors to come in, which is a kind of a mode. We believe that this kind of valuation should get justified going down.
Okay, fair point. So it's a thumbs up from the IPO, for the IPO from Vinith. Vinith, great speaking with you, and thank you so much for analyzing Aether Industries for us. Of course, awaiting the IPO, and we'll chat again soon post-listing, I'm sure.
Thank you for your time.
Thank you. Okay, with that, we come to the end of this edition of the IPO show. Hope you were able to benefit and make your decision on whether or not to subscribe to this IPO. We'll see you again same time next week with yet another IPO.